Hey folks, Jason Witten here. Welcome along to the little video instructional of how to use the off-the-plan wealth calculator. You've just done the download and you might be interested in buying a property off the plan. Myself and my team at Positive Real Estate and my business partner Sam Saggers, we've helped people buy thousands and thousands of properties over the last 21 years across Australia with properties off the plan. And for you and I as investors or maybe even owner-occupiers, understanding our numbers and maybe how wealth is created is not a bad idea. So we thought we would create a spreadsheet, a calculator. So if you're considering the strategy of buying a property off the plan, you might want to know your numbers beforehand and maybe run a few scenarios. So let's dive into it. Thanks for downloading it. Hopefully the calculator is useful for you. So let's jump in. Pretty easy, pretty straightforward, folks. At the start, there's 3 tabs. There's an info tab. If you want to learn more about what we do here at Positive, register for one of these events. It'll take you along to one of our 1.5-hour property investor nights. But other than that, some pretty straightforward information about the financial data input where we need to put some info into the front page here. We'll talk about that in a second. And then our 10-year report. This is a bit of a forecast, an idea. This is not financial planning. This is not a for the tax return or anything like that. This is a forecast. If something happens, if these are the numbers, this is what it might look like. So let's go through this and have a bit of a look at this idea here. I'll whack this back to 0 anyway. Up the top, you get a chance to put in the details of the property that you might be considering, where it is, and the type of property. Now, I suggest if you do this on multiple properties, save a version of it each time, and then, you'll be looking pretty good, really, at the end of the day. I'll pop that in, make that a little bit bigger. Let's have a look. Yeah, there we go. That makes life a little bit easier, doesn't it? So, up the top here, you put in the purchase price. Now, I'm going to put in $750,000, and if you think you get a discount up front, you can put it there. I'm just going to say the market price is the purchase price, and we didn't get a discount. If you did, it'll show that you got maybe some instant equity right at the start. Are you putting in a cash deposit? Are you putting in an equity deposit? For most of us off the plan, we're going to put down probably a cash deposit, and you might use some equity. But if you use an equity deposit, it does calculate some interest, and cash won't incur interest if it's not been taken out of a mortgage, right? So in here, there might be some things you might want to think about capital improvement in the future. This is just for you thinking about the property later on. You can choose to do it in cash. You can choose to do it in equity, whatever that might be. Some legals and some stamp duty as you go along, all right? So, what does that look like? And, how does that work, right? So if you're clicking on this, you can click on the stamp duty calculator over here as well, folks, and that'll take you over to a calculator which is realestate.com's calculator. You can work out the stamp duty, okay, or the number that you might have. Now the costs, all in all, that'll total it up for you, and then you'll end up knowing what sort of costs on settlement day into the future. So the deposit now and some other costs into the future, what might you be up for, okay? Some other things, loan establishment costs, depending on your lending. If you're buying off the plan, it might be 1, 2, 3, 4 years away from settlement time. So your loan may change between the day you put your deposit down and the day you settle the property. Interest rates might change. Your situation might change. Talk to your finance broker about those sorts of things. But, it depends on whether you're paying, money to get a valuation done. It depends on whether you're borrowing, with a high loan-to-value ratio, and seeing if you need to get, mortgage insurance or lender's mortgage insurance, whatever it might be. Anyway, I'm going to leave a little bit of mortgage insurance in there at this point in time, and we can, navigate as we go along. Right, you got all of the other inputs that you might have on the day of ownership. This is not in the off-the-plan section, and you've got also some information about the loan section, the lending, okay? I've put a $75,000 cash amount in there, so that's telling us the loan amount we've got, and it's telling us our total loan-to-value ratio is 90%, okay? Now, that's on average. if when you buy a property off the plan, the property might go up in value and you might be able to use that value to be able to settle the property in the future. Many of our clients have just done that recently, so that's something that's probably worth thinking about. And one of the reasons you'd buy off the plan, if you're an investor, some of those strategies might work. Over here, you can put information in about the rents. And this section, folks, is if you're thinking about renting your property short term. Some of you might furnish it and rent it Airbnb style or something like that. So you can muck around with that if you want, or for students, those sorts of things, right? Over here, there's a section that you can put in for calculating some tax calculations. Why would you calculate tax calculations? It's certainly for cash flow in the future. If you are PAYG, this is a buying the property in your own name PAYG tax variation calculation. So just be clear about that. This won't work for companies or trusts if you're buying it in that circumstance. Okay, and put in CPI, put in capital growth. Now, you can change these figures. Anything in grey on the spreadsheet you can change. Okay, in here, this is the section you change with depreciation. You can leave it as it is. If you click on the depreciation calculator, it takes you off to a little online calculator that you can use for depreciation. Now, if you don't know what depreciation is, then that's fine. Come along to one of our webinars and you can find out what that is. But quick explanation: it is the cost of the dollars of the property infrastructure, which is the building and the chattels and all that sort of stuff, going down. It depreciates, it goes down in value. Your land goes up, your building goes down in value, roughly. And you get to have that as depreciation. You can offset it against your personal tax, get a tax back, negative gearing, it's commonly known as, in the world of property investing. Anyway, that's not what this is about, but you can use this calculator for that. Now, let's just go back up here quickly because this is the main reason, the off-the-plan calculator. You can create wealth, significant wealth, folks, in the off-the-plan time frame. Why is that good? Because you put down a deposit and there's no more to pay for 1, 2, 3, 4 years, okay? So let's just use an example, an off-the-plan property. I might put down my deposit and I don't have to settle it for 2 years off the plan. Just recently, many of our clients, you would have seen them, would have seen a few examples, have made hundreds of thousands of dollars in the off-the-plan time frame in instant equity, and they used that money in the increase in the value of the property to be able to settle that property and put less money in on settlement day, which is pretty good. So anyway, 2 years, you put that in there, whatever it might be, 2 years, 3 years, something like that. And what that does on the other side is calculate some of your capital growth. Now, I'm going to put over here 6% because, capital growth's been running pretty nicely. And I think there's going to be some pretty good capital growth over the next few years. If you have a look at any of the stats, there's, predictions of 5 to 6% capital growth in many of the capital cities. So I'm going to chuck that there. It's pretty conservative. Anyway, it's for example circumstances today. So let's have a look at the results of our spreadsheet, our calculation, and have a look at what's going on here. Now, if you look up the top here, this is a section where it says, this is all of the components that will be expressed in our cash flow scenario here as we go along, before tax cash flow, after tax cash flow, etc. And in this section, which is the off the plan section, we're going to see some wealth being created while you own the property, but there's no more costs. So let me quickly explain that as we go along, because it's a pretty interesting one. Year one, off the plan, you bought the property for $750,000 by the end of year one. Now, the loan amount in the end, because you've already put down a deposit, so you've put down $75,000 as a deposit, that would be the loan amount going forward, and it might be even less if you put more down later on, but that's just the moment. Equity, including your deposit, plus the increase in equity, which is your capital growth, $45,000 gone up in value in year one, and it's cost you nothing to hold that over that period of time. Okay, so in year one, that's pretty good, right? So there's no interest payments, there's no principal payments, there's no expenses. And on the flip side, you're not getting any cash flow from it because it's not rented out. You know what I mean? So, but you are getting capital growth. And that's one of the great things about off the plan as a strategy for investors and also owner-occupiers as ownership. You're already building wealth in the property while it's under construction, okay? And then off the plan number 2, last year, when you bought it, it was worth $750. At the end of year 1, it's worth $795. And if it continues in that direction, it might be worth $842. Now that's fantastic, right? If you add this together, you got $45,000 and $47,000 of approximate equity growth. And on settlement day, close to $100,000 of equity in your property. And have a look at this. This is the good part, folks. Remember when we had a look back here, this is your loan-to-value ratio when you purchased it because you put a 10% deposit in, right? But on settlement day, your loan-to-value ratio is a lot less. Now it's becoming, 87%, which is fantastic. The equity in the property, equity in the property is fantastic. So what does that mean? Well, on settlement day, 80% lending, you don't have to pay lender's mortgage insurance. That's another little benefit of these things as well. If you want to know more about the details of some of these ideas and strategies, well, make sure you come along to one of our webinars. But this is the drill. If that property was 3 years off the plan, then that might be kind of cool. And depending on if you can wait, well, you might get a little bit more equity as you grow over time. So, that's not bad either, right? And the loan-to-value ratio on settlement day is quite low and all those sort of things. So, we use strategies for settling properties off the plan all the time at Positive with our investors and for owner-occupiers as well. So hopefully this calculator is useful. Muck around with it, play around with it, and see what your off-the-plan wealth might look like, all right, with your instant equity. Now, on settlement day, now this kicks in. Now it becomes something you own. And if it was an investment, I'm assuming this is an investment. If it wasn't an investment, you just don't put rent in and you can still see the costs to you as an owner. But listen, hey, you've got your equity in your property, which is fantastic. Your cash on cash return, which is great. You put in 75 and already your equity's, 271. Your available equity, if you could re-borrow it at 90%, might be 177. So that's good too, as you go along. But here's the rent. Actually, we could go back and put a little bit more rent in there, actually. I'd put $750 a week rent. That'll make it look a lot nicer. You got some rent here. And what does that cash flow look like as you have a look? Your interest payments and you got your depreciation and you've got your pre-tax cash flow and then your after-tax cash flow, all right? And that looks pretty good as we go. So happy days, the income's coming in, whatever it might be. Now remember, you've got to put your expenses in here. Make sure you put all of your bibs and bobs in there as well. Actually, I can tell you what, that will not be 3.5, folks. It'll be 6.5. So let's put 6.5 in there. It'll probably make the cash flow look a little bit more amenable. There you go. So a little bit negative cash flow before tax. You get some tax deductions back, a little bit less negative cash flow after tax, and then away you go. Now, don't be afraid of a little bit of negative cash flow because really at the end of the day, you've already got some equity, 140 grand of equity in the property. The property will continue to grow if it's in a great place. So, the net result each year, minus your negative cash flow plus your equity, you're still ahead, and that's, if you want to know more about that stuff and understanding how to structure your investments as you go along, well, come along to our webinars and I'm sure you'll get a lot more out of it. But yeah, hopefully that was useful with the explanation of how to use the spreadsheet, folks. And hook in, let us know if it's of use and maybe see you at one of our webinars sometime soon. That's it from me. Take care. Bye for now.